Continuing with Chapter 2, regarding planning, AS 2101. Let me get to that. If you were to come to campus today, you would have had a plan on how to come to campus. You would get up, do whatever you needed to before you left your residence. Then you would, if you were close enough, walk to campus. If you were not close enough, you would have to be transported to campus by some means. That means might be a personal vehicle, it might be someone giving you a ride, it might be taking public transportation. If you were taking public transportation, you would have to go to where you could get on public transportation. It could be you're taking just one subway or just one bus. That would be relatively easy. But it could be, no, you have to transfer. So you have a plan. If you have been doing this repeatedly, then you may not even think about what is your plan. Page 36, determine and apply materiality levels. Here we need to take a look at AS 2105, 2105. Let me get to that. We talked about something being material or something having materiality. What is something that's material? The concept is that if it would change a typical user's decision, then it is material. If it would not change a decision, then it is not material. We sometimes say immaterial. Page 36, assess risks of material misstatement. Here we're going to AS 2105. And again, as I say, feel free to pause the video at any time so that you can take a look at these things. 2105, especially paragraphs 6 through 9. It talks about establishing materiality in planning and performing an audit. Essentially what happens when the audit team goes to the audit client, the audit team has available the financial statements that the audit client is in essence presenting. For a very small client, there's a possibility that even though it is being audited, what you're really working from is the general ledger. So from the general ledger, you are preparing financial statements which are unadjusted financial statements. Once you have this information, whether the client has prepared it or you have prepared it, you're going to be taking a look and saying, I have to establish a materiality level. How much of an error or misstatement or something being wrong or something being off can I say, oh, that would not change a typical user's decision, and therefore it would not be material. But above that, yes, it would be material because it would change a typical user's decision. There's actually case law on this. The case law says that if it is 5% of net income or less, it is not material. There's also case law that says if it is 15% of net income or more, it is material. So what a lot of people do, they simply say, we use 10% of net income as being an item which is the boundary between material and not material. This is not the only thing that we use to establish materiality. The SEC, Securities and Exchange Commission, has stated that if it interrupts a trend, then it is material. So let's suppose that a company has been increasing earnings every year, and this year, all of a sudden it's not increasing earnings. Why? The earnings are either flat or they go down somewhat. Maybe down a little bit, maybe down a lot. Whether it's down at all or just flat, it interrupts the upward trend, and therefore it is material. We also have other bases, not just net income. If any particular line item in the financial statement is materially misstated, then the financial statements are misstated. Sufficient appropriate audit evidence. This is also on page 36. Take a look at AS Auditing Standard 2315, paragraph 5. Let me get to that. AS 2315, audit sampling. If you are auditing a client, the client has had some number of people working on this all year long. You simply cannot go back and redo everything. If you've had a course in statistics, you're aware that you can sample something from a population and get a really good idea about the population just from taking a sample. So that's what we do in auditing. We sample from various audit populations that the client has. We test the sample, and based on what we find in the sample, we make a conclusion about the entire audit population. So here I mentioned paragraph 5. Let me get to that. The sufficiency of evidential matter is related to the design and size of an audit sample, among other factors. The size of an audit sample necessary to provide sufficient evidential matter depends on both the objectives and the efficiency of the sample. For a given objective, the efficiency of the sample relates to its design. One sample is more efficient than another if it can achieve the same objectives with a smaller sample size. In general, careful design can produce more efficient samples. What that means is, if you plan your work, there is sometimes a possibility of figuring out how to do it better. I'm reminded of a story that I came across. There was somebody who was being asked to figure out how many parts are in this barrel. So here's a big barrel, here's another big barrel, here's another big barrel, and they have some quantity of parts in them. So what had been done previously, somebody would get an empty barrel, 1, 2, 3, 4, 5, and would count the things. I wonder if it could be done any better than that. Someone figured out these barrels are standard barrels. They have a standard size, they have a standard weight. So, take an empty barrel, put it onto a scale. That's how much the barrel itself weighs. Put in some number of parts into the barrel. That's the weight of the parts. So if, for example, you would have 100 parts in there because they were small parts, the weight of the barrel plus 100 parts minus the weight of the barrel itself, that's the weight of the 100 parts that were in the barrel. Divide that weight by 100 and you get the weight of each part. What can we do with that? Well, take that off the scale, bring in another barrel that's full, put that onto the scale. You may need to use a forklift to do that, but somehow get that barrel onto the scale. You now have a weight. That is the weight of this barrel plus all the parts that are in it. This weight, that is the barrel plus all the parts that are in it, subtract out the weight of the barrel itself. This is the weight of the parts. You've already figured out what is the weight of an average part. So, whatever this weight of the parts divided by the weight of an average part tells you how many parts are in this barrel. Okay, you now have a very good estimate of what is the actual number of parts in this barrel. You may be off by 1, 2, whatever, That's close enough. Take that barrel off, bring the next barrel, put that onto the scale, go through the same process, take that off the scale, keep doing each barrel, and you have a very quick way of saying, here's how much inventory there is of these parts. It's a more efficient way of doing things than simply taking it out of one barrel, putting it into an empty one, taking it out of one barrel, putting it into an empty one, and so on. Page 37, reporting. Let's take a look at AS 3101. The auditor's report on an audit of financial statements when the auditor expresses an unqualified opinion. The accountant, not the auditor, should also report on reviewed and compiled financial statements if the accountant is involved with them. And you should not say that the auditor does a review. You should not say that the auditor does a compilation. You should not say that the auditor does a preparation. The accountant does a review. The accountant does a compilation. The accountant does a preparation. That is something that you should see in the standards that were reviewed for homework for either Chapter 1 or Chapter 2. Page 37, Principles versus Auditing Standards. The Europeans were appalled at some of the things which became known about how U.S. companies reported phony financial statements with the blessings of their auditors. The auditors gave them clean or unqualified opinions. We use both those terminologies. They claim that the international standards used in Europe are more principles-based, while the standards used in the U.S. are more rules-based. I have a hard time believing that. When Daimler-Benz, for a while Daimler Chrysler, and now I believe it's just Daimler since Cerberus bought Chrysler, and then it has become Fiat Chrysler. Kind of reminds me of playing a game of Monopoly. Change from German accounting standards to U.S. accounting standards, it wrote off, and this was decades ago, it wrote off about $495 million against its income statement, which, for all practical purposes, people believed it had been hiding, but which seems to have been permitted under German GAAP. And this is in the days before we went to international financial standards. So yes, there were national GAAPs. I'm making an assumption here that if it had not been permitted under German GAAP, then its auditor would not have approved the financial statements. Also in December 2003, the Parmalat situation blew up. Parmalat was a big company, originally in dairy products, headquartered in Parma, Italy. The Italian word for milk is latte. So Parma latte, shortened to Parmalat, all one word. It claimed to have billions of dollars in cash deposited in the bank, when in fact the money did not exist, and the auditors had issued a clean opinion. Well, wait a minute. These were European auditors. European auditors for Daimler, European auditors for Parmalat, and there have been other situations also. So it makes me wonder, is this really true? I'm going to stop this video at this point. Why? Because there is a size limit to be able to post it onto Blackboard.